Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, August 20th, and something seems awry here. Following a Barron's article over the weekend, the market has been abuzz with talk that government-sponsored enterprises, Fannie Mae and Freddie Mac, are destined to need rescuing by the U.S. Treasury. Think about that for a minute. The two agencies combined own or guarantee more than $5 trillion of home mortgages, or roughly 40% of all U.S. mortgages outstanding, and they are considered to be on the verge of needing to be bailed out by taxpayers, many of whom are in their homes on account of GSE financing activity. Depending on whom you talk to, the concern about the GSE's capital position is either right on or, quite simply, off the mark. Fannie Mae CEO Daniel Mudd would support the latter viewpoint. In an interview with National Public Radio Wednesday, Mudd proclaimed Fannie Mae has more capital than it has ever had in its history. Critics, though, would quickly counter with the point that the capital position is still woefully inadequate relative to the $2.5 trillion of mortgages Fannie Mae has guaranteed. Thus far, the critics have unquestionably had the upper hand in the capital debate. Shares of Fannie Mae and Freddie Mac are down 95% and 96% respectively from their all-time highs, and have fallen 39% and 45% alone since the aforementioned Barron's article was published. The spread in yield on their debt and U.S. Treasuries has widened, which is remarkable given that the passage of the housing bill provided an explicit guarantee of the debt. Separately, the Wall Street Journal reported that Freddie Mac completed an auction of 5-year notes Tuesday that were priced to yield 1.13 percentage points over the benchmark Treasury note. That was the highest spread Freddie has ever paid on such debt. The silver lining is that the auction was completed in the current environment. The dark lining is that it came at a high price, and higher borrowing costs for the GSEs could very well contribute to higher mortgage rates, which is not a positive at all for the depressed housing market. One can see that there is a lot awry about the GSE situation. The one thing that seems particularly awry this week, though, is the market's reaction to it. Consider for a moment that Fannie Mae and Freddie Mac are at the epicenter of mortgage financing, which is the main driver of demand in the housing industry. The housing industry, in turn, is at the epicenter of all the losses and write-downs that have been reported by the financial sector, which has been at the epicenter of the stock market's losses this year. With these thoughts in mind, one might think the stock market would be in the midst of an epic, fear-based sell-off driven by the GSE concerns. In actuality, the market has held up reasonably well. Granted, the market was down close to 2.3% for the week as of this recording, but considering the market was up 8% since the July 15th low entering the week, that still has the markings of normal corrective activity. Moreover, the decline has occurred on light volume, indicating there hasn't been a lot of conviction behind the overall selling efforts. The response to the GSE situation could grow more severe over time. Then again, it might not. The behavior of the stocks of Fannie Mae and Freddie Mac this week shows investors in the common stock are anticipating the worst fate. Accordingly, there is fire sale selling in an effort to try and salvage something, lest there be nothing left to salvage down the road. The broader market, meanwhile, is a tougher read. It is either resigned to the idea that a rescue of the GSEs is inevitable and has already been largely discounted in the market, or that it believes the press surrounding the GSE situation has more hype than substance. We don't know the outcome here. What we do know is that the stock market's behavior so far this week hasn't matched the gravity of a rescue situation. I'm Pat O'Hare for Briefing.com. Thanks for listening.